So next we're going to explore how the federal government is tackling greenwashing and its implications for the carbon market. Allison Joutsi is principal at ESG Global Advisors and has significant experience building ESG programs and managing sustainability risks and opportunities for corporate clients. Her diverse background in law, business, and communication allows her to build ESG strategies that integrate with existing corporate goals and priorities, generating long-term return on investment. She is regularly called upon to present to boards and speaks at various events on ESG regulation, disclosure, climate risk, and is a frequent guest lecture to students on ESG strategy and reporting. Ladies and gentlemen, please welcome Allison to the podium. Allison.
All right, well, hi, everyone. We'll do a quick sound check. Everyone can hear me? Perfect. Well, hi, I'm Allison Joutsi. I'm a principal with ESG Global Advisors, and I'm really excited to be here with you all today to speak about something that I'm very passionate about, specifically around Bill C-59, which amends Canada's Competition Act and now brings in greenwashing under the purview of the Competition Bureau. So we'll make this interactive, and if you have any questions as I go throughout the slides, please feel free to raise your hand, and I'm more than happy to take questions on the spot. But as I go through some slides here, I want you to keep in mind three key messages here. The first is that climate risk is financial risk. And as a result of this, businesses are now building climate strategies and investing in decarbonization and transition plans, which presents a huge opportunity for carbon market participants. The second area is ESG and climate reporting is on the rise across all sectors. Private companies and publicly traded organizations are choosing to invest in a climate report as a compliance mechanism or to comply with supply chain requests. Again, huge opportunity for the carbon market to support with compliance here. And the third area which we'll touch on is Bill C-59, and that's anti-greenwashing now. And we'll talk about the penalties and again, how the carbon market can support compliance there as well. But before we move on, I want to level set and make sure everyone in the room understands why climate risk is financial risk. So as Marty was mentioning, when we talk about ESG, it can mean a whole variety of different topics. So under environment, there's biodiversity, there's air pollution, there's water quality, and so forth. Under social, there's supply chain, human rights, and governance really is how you manage your business. Traditionally, we've been aware that liabilities, assets, and revenue all have the potential to impact corporate performance. But now investors and capital market participants now understand that there are non-traditional financial measures, such as GHG emissions, that if it's not properly managed, can also impact corporate value. And that's why businesses are now starting to invest in climate strategies, because investors and their supply chain are asking for emissions information in order to continue business relationships. So this is really important to keep in mind because I'm often asked in my role, what happens if there's a change in government? What happens if ESG regulation goes out the window if there's a majority conservative government? And the answer is, I don't think it's going to go away because the whole movement has been driven by investors and capital market participants. And climate risk is truly just another way of managing business risks and opportunities. And it's emerged as the most systemic ESG issue in recent times. As you can see here, climate change is systemic with broad and significant economic impacts. And SASB research indicates that climate change could materially impact 89% of capital markets, or $45.1 trillion. And as a result of this, we're seeing a growing regulatory movement, evidenced by the Canadian Securities Administrators and the SEC, as well as other regulators around the world, which I'll speak to in a few moments. So as a result of this widespread belief that now climate change is financial risk, we're starting to see a lot of businesses commit publicly to net zero. And as Marty was saying, when a business commits to net zero, what they're essentially saying is they're committing to reducing their Scope 1 greenhouse gas emissions, which are those direct greenhouse gas emissions, such as corporately owned vehicles. Their Scope 2 greenhouse gas emissions, which are those indirect greenhouse gas emissions, so the electricity that you purchase. But if you're committing to net zero, you also have to reduce your Scope 3 emissions. There are 15 categories, and they're all upstream and downstream value chain emissions. So really important to keep in mind, what we're saying here is one organization's scope 3 is another organization's scope 1 and scope 2. So say if you sell into Sobeys, for example. Sobeys has made a very public net zero commitment. It is now going out to some of its key business partners and asking for those organizations to also calculate its scope 1 and scope 2 emissions and set science-based targets so that Sobeys can now reduce its scope 3 emissions. And that's really important to keep in mind when we get to talking about Bill C-59, because when an organization has publicly committed to net zero now, it now needs to have evidence showing how it's actually going to reach those commitments, which again presents a huge opportunity for those in the carbon market industry. So just a few key takeaways before we move on to regulation here. Climate risk is financial risk, and it's the leading ESG issue, and it's not going away. With or without regulation, businesses are choosing to invest in a climate strategy in order to continue certain business relationships and just to manage financial performance. And again, this is a huge opportunity for carbon market participants in the room here to support businesses achieve climate goals. And on the flip, if you're a business that potentially sells into a company that's made public commitments, it's really important to start talking to your key business partners so you can better understand what environmental information they may be asking you to continue the business relationship as well. So now that we've talked about why climate risk is financial risk, we'll move on to some key climate-related regulation. I'm going to build on some of the topics that Marty was speaking about earlier. So before we zoom into Canada specifically, I just want to zoom out, especially because we're really starting to experience the interconnectedness of global value chains here. But specifically to Canada, there's OSFI B15 Climate Risk Management Guideline, and that applies to all banks, insurance companies, and crown corporations holding more than $1 billion in assets. These organizations now have to publish a climate risk report modeled after the Task Force on Climate-Related Financial Disclosures. And a key part of that regulation includes Scope 3 emissions. So Scope 3 emissions, again, one category includes financed emissions. So again, what this means for businesses in the room is depending on who you do banking with, they very likely are going to be asking you for your Scope 1 and Scope 2 emissions so the bank can report on that one category of Scope 3 emissions. So again, really important again to talk to some key stakeholders, understand what are some potential access to capital opportunities, and really start taking those steps to calculate your carbon footprint and set decarbonization goals. The second key piece of regulation that's upcoming is from the Canadian Sustainability Standards Board. And I'll touch a little bit more on that in a few moments, but essentially what very likely will happen is publicly traded companies will have to report on how they're managing their carbon footprint along with their annual financial filings. Whether or not Scope 3 emissions will be part of that regulation is still up for consultation. But again, just to keep in mind that we're starting to see this growing movement of climate reporting in Canada. C-59, again, we'll touch on that later as well, but now greenwashing is under the purview of the Competition Bureau. Again, what this means is that companies that are in the carbon market or that are in banking or really any private industry as well, if you make a public commitment around net zero, carbon neutral, if you say your business is green, you now need to have testing and you need to be able to align those statements to internationally recognized methodology, or you can face significant monetary penalties. Moving on to the states, the SEC has passed a climate rule, and while it is on pause, the state of California, which accounts for roughly 60% of the American economy, has two leading pieces of regulation. One that asks organizations that reach certain thresholds to report on their Scope 1, Scope 2, and Scope 3 emissions, as well as another leading piece of regulation asking those in-scope organizations to report on climate risk management practices. So while this might not appear to directly impact businesses in Canada, if you do business, or if you have a growth strategy, or a customer acquisition strategy that targets any business that is impacted by a regulation in California now, they are going to be asking you for your carbon footprint, along with setting science-based targets to continue business relationships. Over in Europe, Europe is one of the most mature jurisdictions when it comes to sustainability reporting. And a leading piece of regulation there is the CSRD. That's the Corporate Sustainability Reporting Directive. And that impacts over 50,000 businesses in the EU alone and roughly 11,000 in North America. And what this regulation asks in-scope organizations is to comply with both the EU taxonomy as well as publish a European Sustainability Reporting Standards report. A key part of that report again asks organizations to calculate its Scope 1, Scope 2, and Scope 3 emissions, as well as have a legitimate decarbonization plan. And just to give you an example of how this impacts Canadian companies, one of the clients that I'm working with, they're a non-for-profit research lab, less than 20 employees. They do research for AstraZeneca. AstraZeneca is based in the EU, has to comply with the CSRD. Because AstraZeneca now has to report on its Scope 3 emissions, they've asked all of its business partners, irregardless of size and revenue thresholds, to calculate its Scope 1 and Scope 2 emissions and to set science-based targets. So now this small not-for-profit research lab, in order to continue doing research with AstraZeneca, has to now calculate its emissions, set targets, and now is in the process of publicly committing to net zero. Again, which is an opportunity for those in the carbon market to support those Canadian businesses that are part of the value chain of companies that are caught by global regulation. Finally, also Australia. Just in the past 2 weeks, they've also passed climate-related regulation, impacting companies in Canada that are dual-listed, or again, that have growth strategies or customer acquisition plans. So again, just a few key messages here before I zoom into Canada specifically is that we're really starting to experience the interconnectedness of global value chains. Depending on businesses' customer acquisition strategy, they are starting to have to calculate their carbon footprint to continue certain business relationships. And I would even argue now that it even goes beyond just a value proposition. It's pretty much becoming table stakes for every company to have some level of carbon and climate commitment. So if we zoom into, can I just get the slide changed? There we go. So let's zoom in a little bit to Canada here. So the Canadian Sustainability Standards Board, this was created to advance the adoption of Canadian sustainability reporting standards in Canada. And essentially what the CSSB has done is they did due diligence on the International Sustainability Standards Board standards in order to take into consideration certain Canadian-specific requirements. And what they've done is they've released 2 draft standards, CSDS-1, which are those sustainability-related disclosures, but specific to this conversation is CSDS-2, and those are climate-related disclosures. The consultation is now closed, and we're expected to see the final standards released towards the end of this year. Following that, the Canadian Securities Administrators will launch their own consultation and publish a final climate rule, which will then be up for Canadian regulators to adopt and make it mandatory for publicly listed entities to report a climate report along with their annual financial filings. Whether or not Scope 3 is part of those final standards is still up in the air, but again, what this should signal to everyone in the room is that having a carbon footprint and a climate presence is pretty much becoming table stakes, and this whole movement is becoming regulated now. So it's really important to talk to your stakeholders and to start integrating climate considerations into your business. And as you can see here, regulators are welcoming the launch of the consultation here. So again, this should send a clear signal that this is welcomed right now and that businesses in the room should really start focusing on how they're going to commit to climate. And if you're a carbon market participant, again, this should signal a strong opportunity for you that many businesses are going to be making public net zero commitments, and they will need credible offsets to support with those publicly made statements. So a few key takeaways here before we move on to Bill C-59 is that we're starting to experience the interconnectedness of global value chains. Irregardless of size, all businesses are now starting to have customer data requests as it relates to Scope 1, Scope 2, Scope 3 emissions. They're being asked to set science-based targets. They're having to invest in credible decarbonization and transition plans. Public companies very likely will need to start reporting on climate disclosures, which again presents a huge opportunity for those in the carbon market here. And there is a real need for companies to reduce their emissions through credible carbon offsets. All right, so we'll move on to Bill C-59 too, and then again, we'll have some time at the end for questions as well. But Bill C-59, this now signals that greenwashing is now becoming heavily regulated. So this amends the Canadian Competition Act, and it did receive royal assent June 20th, so now this is law. And this applies to all businesses doing business in Canada, including foreign businesses doing business. So if you're in the carbon market industry, if you're publicly traded, if you're a private organization, you are in scope for this amendment to the Canadian Competition Act. and greenwashing now is under the purview of the Competition Tribunal. So what this does is it creates new ways for stakeholders to challenge companies' public environmental commitments, statements, and goals. And it's now viewed as deceptive marketing. So what this means is if you're a company and you've publicly committed to being net zero, carbon neutral, if you say you've set science-based targets, if you're saying you're a green employer, anything related to a product or a service, you now have to have proper testing in place to back up those claims. Or if you're a service provider, you have to ensure those statements are aligned to internationally recognized methodology. And if you don't, the onus is on the business to prove those claims can be justified. And the monetary penalties are quite steep, as you can see, upwards of 3% of your worldwide gross revenues. So a few key features of the new amendments is that this is a higher bar to justify environmental claims now. Deceptive marketing prior to these amendments fell under the general advertising provision, which means that they had to be materially false or misleading to contravene the act. But now under the amendments, any environmental commitment, statement, or goal contravenes the act unless it can be backed up by proper testing or aligned to internationally recognized methodology in the case of services. So this introduces quite a higher bar to justify any of these public claims and commitments. So let's use the example. Many businesses, as we saw, have committed to being net zero by 2050. So now it's not enough to just have this publicly made. What the organization has to do now is they have to calculate their carbon footprint, align to internationally recognized methodology, which would be the GHG protocol. They'll need to start setting science-based targets aligned to the SBTI. They'll need to have a credible transition plan in place, or decarbonization plan, again, aligned to a credible framework. And then again, they'll have to ensure that how they're communicating this shows reasonable progress year over year. So again, opportunity for carbon market participants to ensure that their products communicate how they can support C59 compliance for companies that right now have made these public commitments and very likely have not taken the proper steps to back these commitments up with. There are complexities around the amendments, and I would encourage everyone in this room to respond to the Competition Bureau's public consultation. We're responding to that. It does close this Friday, but it's just an online questionnaire. But complexities around the amendments really speak to, what is internationally recognized methodology? What is a proper test? So again, they're looking for guidance on what these terms should mean. I do believe there is sufficient evidence out there, as the GHG protocol is pretty much an internationally recognized methodology. There are reporting frameworks out there, too, that demonstrate credibility in how businesses are communicating this. But again, still a lot of gray questions out there in terms of what would be sufficient to meet court standards. The other complexity around this is the public interest, and that's really significant, too, because under this new amendments, individuals like you or I, or advocacy groups, now can bring a claim to the tribunal, alleging that a bank, for example, or a company has made a public statement and isn't actually taking proper steps to meet those public goals. So you can imagine the amount of litigation that this is now going to open up. So again, a complexity, and the tribunal is also asking for a comment on whether or not this is reasonable. So a lot of gray areas, but again, just key takeaways. If you're advertising or marketing a product to be environmental, if you're a business in the room that has made a net zero goal, really important to go through some of those statements and make sure that you have the proper testing, because this now is in effect and the monetary penalties are quite severe. But just a few key takeaways, and then I think we'll have a few moments for questions. So what should businesses do? So first, review all environmental claims. Just make sure you go through any public marketing material. That could be on LinkedIn, that could be on your website, that could be in your annual financial filings, it could be anything in your investor materials. Review it, and if there's any in-scope terms, make sure that you have an auditable record. So make sure your carbon footprint's aligned to the GHG protocol, make sure you're in the process of showing reasonable progress to putting a transition plan together, and so forth. It's recommended to align it to a recognized framework to demonstrate credibility, such as the TCFD or SASB or the GRI. And ensure the claims can be properly tested, or I might suggest you modify how the statement is communicated. A lot of companies, though, are taking down their sustainability reports, And that's really not the intention of this legislation change. It's really just to prevent organizations from making blanket statements and not actually taking reasonable progress to back those statements up with. So again, really important that businesses don't stop reporting. It's really just to provide more structure around forward-looking claims and statements. And then finally, what should carbon market participants do now? Again, ensure how you're communicating your products or services are certified. And again, I would use this as a differentiator too and a value proposition to help businesses comply with those net zero goals and statements as well, by ensuring that your product supports compliance. And again, as I mentioned, I would encourage everyone to participate in the Competition Bureau's consultation, as they do want to make sure that guidance is reasonable and it takes into consideration all different participants in the room. So with that, thank you. If there are any further questions, I'm more than happy to answer them now as it relates to Bill C-59 or anything else I spoke about in this presentation.